Today is April 14, 1:13 p.m. And we saw some unusual options on Honeywell, HON, and we'll show that and also propose a different trade because the unusual options we saw require a lot of buying power. And today it's trading at about 0%. It has had a rally, but today it's kind of rallied in the morning, but then it has come back down. So could we be at a resistance? Because back in early March, this was where the price was also at, around at this 196. And keep in mind here, $200, it never broke $200 back in March. It was almost there at 199. So that major psychological level was never broke. And also here, the earnings are actually coming up too on April 27. So without further ado, let's take a quick look at those unusual options we saw. At 9:59 a.m., you'll see these 10,000 contracts for the May 19s at the 180 puts, and then the June 16 210 calls. So this already, we know, takes a lot of buying power because you're essentially saying you're willing to buy 100 shares of Honeywell for 180 by selling that put. So that's a quick calculation. If we don't even take the selling the calls into account, that's 18,000 for per contract. You multiply that by 10,000 of these, that's already $180 million. So this is quite a large bet. This is, again, just the put side here selling that. We haven't even calculated the call side. So we definitely know this is a large institution. So what were they trying to do? Well, let's take a look. On May 9th, June, the 210 calls, they're selling the 210 calls. So you see their 10,000 contracts here, right here at the 210s. So they sold that. And then they sold the Mays 19, the 180s here, right here. So you'll see here the 10,000 contracts here, right? So they sold the 180. And we can analyze that, and you'll see that what they essentially did was almost like selling a strangle. It doesn't show up here because they actually picked different dates, but if it was all the same dates and they were selling them, they would be selling a strangle. These are good earnings trades because their Vega is actually negative. You'll see here a negative Vega here. That takes advantage of the volatility that will contract after earnings. Positive theta, which is good for the trade, and a negative 8 delta. So slightly bearish, probably because of the resistance that we're hitting. And so that's their trade. Okay, so let's go over our trade where we don't have to use so much buying power. This was our trade it was on the May 19th here. So instead of selling the 180, we sold the 185 and then we bought the 180s. And then we also sold the 195s calls here and bought the 200 calls. Okay, so what is this? Well, this is selling an iron condor. So it's almost like a strangle, selling a strangle. However, it is risk defined. That's why the buying power doesn't require as much. And so this is what our trade looks like. You'll see here, it does take a buying power of 500 because of the width of the strikes is 5. You collect $342, and you'll see here our Vega is also a negative, which is good for the earnings trades. when they contract. Also positive theta and a negative delta. Very similar to their trade here. You'll see here. Yeah, so if you wanted, let's say, more Vega, you just add more sell more iron condors, or if you wanted more theta or delta. So, and let's look at the break evens. Okay, so the difference is going to be at the break evens. The break evens here on the iron condor at expiration is 198. Since we never broke that 200, we have it at the high end at 198 here, right here. And the break even here on the low end is 181 at expiration. So for their trade, take a look at it here. It's actually a lot wider because they never bought the wings of the iron condor. It's 176. So, and then on the high end, 207. So it can actually go above 200 on their trade. So that's the advantage with selling a strangle. It's a lot wider. You have a wider profit margin here. Yeah, so that covers a lot more range to profit from. But it does take a lot more buying power. So what we may end up doing, it looks like because earnings is maybe about 10 days away. Was it April 27? About 10 to 12 days away, or 2 weeks. We may actually close our iron condor right before earnings because of the potential risk. We'll monitor that and see what to do at that time. But that's sort of what we are thinking. But it'll depend on, as we get closer to earnings, and how this trade performs, and seeing how it does right before the earnings on April 27. Okay, so if you found value in this, please give us a like, subscribe, and hit the bell icon, and you'll be notified whenever we see these unusual options. Take care, everybody.